Hello and welcome to Series 2 of Get Your Dollars Up. This is now episode 1, and if you're new, what I do is I go through a history of my trades. I show my gains and losses as a consequence of the trades, and then I will talk about the theory. I will talk about the rationale as to why I make specific decisions. And something that I'm going to add is talk about the emotional side of things. I think to be a good trader, not only do you have to have a certain amount of intelligence, but you also have to have a certain amount of EQ to be able to check your emotions, whether they're good or bad. They can influence you on how you trade and the decisions that you ultimately make. Just like in real life, when you're under distress, you may not be making the best decisions. And so when it comes to trading, this can be dangerous because then you've got money on the line and you could be making bad decisions. And so you need to be at least aware of that. Um, and we're going to just jump right into it. Okay, so the bigger strategy is what I call the wheel. Sometimes you may not hear other people call this the wheel as well, or maybe there are some other terms. But effectively, this week we're starting off with cash. On Monday, had cash, and I sold a put. So a put is an option that is giving the right for some person to buy at a specific price. So if you're concerned about a stock going below a certain price, then that's why you would buy a put. You would buy the right to say, hey, I don't want to have to sell this below a certain price. Will someone else take that risk for me? I'll pay you for that risk. And I am basically taking the other side of that. So whenever you deal with options, it's you versus them, right? So here I am, average dude, and the other guy is what I'm imagining to be some guy in a suit, being evil and super cartoony. Thanks, Shutterstock. And but at the end of the day, what it really is it's a zero sum game. When you trade options, one person wins, one person loses on that one specific trade. But then it's just a tool, right? And so how you construct everything in terms of your trade is going to determine your failure or success. And so coming back to this idea, sold a put, what this means is I am giving someone else the right to sell a stock to me for a specific price. I am taking that risk to say, hey, if it goes below this, I'll buy it for you for a agreed upon price. And so what I did this week is actually shown here in this gain loss graph. This is pretty typical for short puts. Short means you're selling, long means you are buying. And so I sold a put, and here's the maximum gain that I can experience. $1.78 is what I sold the put for at 124. This is for Apple stock, trading on the 11th, that December 11th. So it closed already, and we're now looking at things after the fact. But if it had closed above 124, my gain is still a certain amount because I don't own the stock. All I got was the premium. And if the stock went above 124, I get my maximum gain. Okay, now if it goes below, there's a point where I am at break even because I've seen the stock go down the exact same amount as what my premium is. I received 178, $178. For 100 shares of Apple at $124. And so if Apple goes to zero, obviously I lose everything below this amount, okay, below the one roughly 123. Um, and so it's important to understand that I am taking on risk, but it's also the same level of risk as holding on to any kind of stock on its own. And so I'm essentially saying I'm going to buy this. Okay, and so this is the gain loss graph. I get into loss territory as the value of the stock starts to go further down. So it's important that you only do this in a stock that you firmly believe will continue to go up over the long term. Okay, so this is the gain loss, and here's a different way to look at it. So this is Apple. This is captured at the end of the week, obviously, because I entered the trade on Monday. It was trading around 24. I thought, hey, you know what? I think this thing is going to stay roughly flat, and I'm okay with owning the position. And so on Monday, I sold the put at 124. I received the premium of 178. So my break even is 122.22. A little bit of a coincidence there. And obviously on Monday, I didn't know what was going to happen through the rest of the week. But as it turned out, it went up, came down, and it stayed down pretty much for the second half of the week, eventually closing out at 122.41, which is okay. I'm actually still in somewhat positive territory. We're talking really small amounts here, by $19. Nothing to write home about in terms of being terribly excited about gains. This is not why we do it. But I effectively will now have the stock. I had to buy it at 124 from someone else. They were able to exercise that put onto me. And so now I have 100 shares of Apple, which I bought at 124, but my true break even is down here next to the smiley face. Okay, so next week, what we're going to do is get into the other half of the wheels, right? So this week I went from cash, sold a put. Unfortunately, it got exercised because the stock fell in value to below the strike price. I had to buy it, as was the original arrangement and agreement. And so now I'm at this second stage of the wheel. And so, if you were to think about this, the shortest cycle for the wheel, if I do things on a weekly basis, is 2 weeks. That each week, the first week I get put the stock, and then the second week I sell a call and it gets called away because the strike price is then above. A call is the right for someone to buy it at a specific price. This is the right to sell at a specific price. This is the right to buy at a specific price. And so we're at this point. Next week, I'm going to engage into this side, so I'll describe what's going on there. Okay. But at this point, we need to discuss the final piece that I thought I would add into the conversation here, and this is the EQ check, right? The emotional intelligence side of trading, because what happens? What are some of the most common emotions that people experience when they are trading? Fear and greed. And this is important because if you're acting out of fear, it may not be rational. If you're acting out of greed, it may not be rational. And so, what was I going through this week? Well, let's see. Started out here and I saw it go down. I saw it go down to under 120.5. And I was thinking, oh my goodness, I am already out a couple $100 over the course of 3, 4 days. And this is starting out with an original 12,400. And so that's a relatively mild swing in the grand scheme of things. I wasn't honestly too bothered by it, but if it took a bigger dip, let's say it went from 124 to 115 or something like that, that's a pretty big move in a week, and I really wouldn't feel good about it. Um, Someone in this situation could bail and say, you know what, I don't want to own the stock. What if it keeps going down and I just can't make it up? I'm just going to take this loss and go away, right? But I firmly believe that if you stick it through, if you can consistently stay with your strategy longer, then you have greater odds of success. And a lot of this is statistics, right? If you've built up a good system that wins even 51% of the time, the more that you do it, the more successful you will be. The higher frequency of shifting the total odds in your favor to become overall positive if you have a system that works at least 51% of the time is really good as the law of numbers gets kind of larger and larger. Okay, so that's a little bit of statistics. Hopefully that makes sense. But coming back to this emotional check here, there was a little bit of fear that I experienced, but it did not deter me from the bigger strategy that I've got. So hopefully that is something that you can evaluate as well. This is something I try to keep in check every time I make a trade, whether it's good or bad. And if I have a long streak of things that are going wrong, then I think I might need to just pause and reevaluate. And that's healthy as well. I don't need to keep pounding on the same strategy if it's not working. Maybe the climate has changed. Maybe the strategy just doesn't work anymore and we got to change it up. That's okay. That's perfectly fine. We have to be adaptable. And so that's the end of episode one. In episode two, we're going to start to get into some covered calls. Once we own the stock, we're going to sell the right for someone to buy it from me at a specific price. Okay? All right. See you in episode two. All right. Bye bye.